Hello, welcome to this video where we will see what all we can invest into in the stock market. If you didn't see the previous video about what is an index, please go ahead and watch it first so you can understand this video better. So today we will see the difference between a stock or a share, mutual funds, index funds, ETF and bonds. As you may already know, a share is a piece of the company, which, if you buy it, makes you partial owner of that company. In order to be able to invest in specific shares, you have to have a lot of financial knowledge and know how to distinguish between companies that are undervalued and that still will be there in like 20 years or whenever you're planning to retire. So you can invest in them and make profits. Despite the fact that there are many people who call themselves professionals and want to choose specific stocks, studies show that less than 4% really know how to do it. And these are the billionaires like Warren Buffett. So if your financial advisor tells you that he knows how to choose individual stock, better run. Unless, of course, he is one of those billionaires. So let's see what are mutual funds. A mutual fund is like a pack with many different stocks in it. You only have to invest in one, and instantly you invest in all that are in that package. They usually have a minimum of 90 shares in it, which makes it very difficult to replicate on your own, because then you would have to make 90 separate purchases. Therefore, all mutual funds offer a great advantage of diversification. Mutual funds can be actively managed, which means that an investment professional picks individual stocks for you with the intention to beat the market and obtain a higher return than index has. In order to do this, they charge very high fees, like 1 to 2% of all your portfolio annually. If they make a bad choice and you lose money, they will still get paid those high fees. Their performance generally is very bad, as studies show that 96% are unable to beat the index in long term. So basically, you pay more to earn less. In contrast, index fund or ETF use passive management strategies following a fixed formula replicating the behavior of an index. They have much lower fees. For example, Vanguard ETF S&P 500 charges annually 0.03%. ETF and index funds are very similar, with the only difference is that the index fund can be traded only once a day, whereas ETF can be traded as long as the stock market is open, as a normal stock. All the index funds are mutual funds, but not all the mutual funds are index funds. If a mutual fund is index or ETF, it will be clearly stated in its name. So, and what is a bond? A bond is like a loan. You can loan money to the government or to the company. You can choose the duration of the loan, when it will be due. We say it will be mature. For example, the loan can mature in 5 years or in 20 years and so on. In exchange of your money, you will get paid interests that can be monthly or quarterly, and at the maturity of the bond, you will be refunded all your investment. Bonds are generally considered low-risk investments, as because of being a loan, there is a legal obligation to return you the investment. The disadvantages is that they also give lower profits. So your investment goal should be to create a diversified portfolio with a mixture of bonds, index funds or ETF. We'll see it in another video, how to create it, as well as the risk of investments and how to decrease them. Thanks for watching, press like and I'll see you in the next video.